This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, as always, my colleague Sonia and Nigel. Guys, hi, good morning.
Good morning.
Welcome to a new four-day week, right? As Nigel reminded us, last Friday, was it?
Yes.
The best thing about the week.
Thursday, right?
Thursday is the
Need to pull
holiday, yeah.
2 or 3, then you get a bit of a break and come back to the
and,
finale.
and then finish it off, right?
And it's the last week before the budget, so if that pre-budget rally is something that people are expecting, perhaps it could play out, given that we have such positive triggers today.
I mean, we have the market in the US turned around brilliantly, right? And we were talking about this actually on closing bell on Friday and on the editors' roundtable as well, that the US is basically at a very critical juncture. The trend line all the way from the Jan 21 highs has held. And every time the market has tried to bounce back to those levels, which is roughly around 4,000 on the S&P 500, it's sold off 10-15%. Thursday looked pretty ominous. And Friday, we've attempted a very smart pullback. The changes on your screen, the S&P up about 1.9, the NASDAQ up about 2.6%. So these are big rallies. And this was accompanied, mind you, with yields going up. I mean, the 10-year, for example, in the US on Friday, the 10-year yield was up 10 basis points. Okay, what led to this? Let's just quickly put this up. There were two comments from Fed officials, senior Fed officials, which was very clear and explicitly dovish. So there was a gentleman called Mr. Waller who said that the Fed policy, monetary policy, and I quote, is pretty close to sufficiently restrictive at this time. What do you read from that? I mean, he, of course, prefaced this by saying that I support 25 in February. So yes, 25. But then he said it's pretty sufficiently, it's where we want it to be. So not very much upside from here. Then you had Kansas Fed's George who said, Fed will be more patient at this time to see if inflation remains on the right trend. So for the first time, and I think you had one more comment from another Fed official the week before. For the first time, you've got a lot of senior Fed officials coming in and saying that inflation is on the right track and maybe the policy is, it's at a place where we can kind of put it on hold and see if this is sufficient or not. By the way, the FOMC has gone into a silent period starting Friday, so you won't hear from Fed officials anymore all the way till the policy itself. Now, let's come to some of the cues here in India. You had three big numbers which came through, Reliance, ICICI Bank and Kotak, and we'll discuss all of these in detail. ICICI sort of hit it out of the park, very strong numbers, but that has been true for so many quarters now. Kotak Bank, I think, is the more interesting one because the stock has underperformed so much and the numbers were very solid. Growth is starting to make a bit of a comeback in Kotak, and that's also something we'll discuss. And Reliance has also posted a pretty decent set as far as the third quarter is concerned. So you're coming into the session with strong global cues and you're coming in with stronger earnings as well. And this matters because, last week it was more disappointing than surprising on the upside, with most consumer companies seeing earnings downgrades. You will not see those with banking numbers, and I think you don't see that with Reliance as well. Where did the Nifty leave off on Friday? It was exactly almost at the 20-day moving average, which is at 18,043. The market left off at 18,027. On the way up just a few levels, 18,184 is the level to cross for more upside. So it's not very far from here. You get a decent bounce. You get to somewhere close to vicinity of that. On the way down, it's the same range levels that we've been highlighting. 17,853. Is the first level, which was the swing low last week, and then the big low, which is 17,761, which is, basically the low which was made right after December. So those are the two levels on the downside. Bank Nifty did better as compared to the Nifty on Friday. Nifty was down 80 points. Bank Nifty actually ended up about 0.4%. It closed in the green. The 20-day for the Bank Nifty stands at 42,596. We closed at 42,506. So that's exactly, you're going to take that out on the way up as we open. But the point is a decent close above the 20-day, I think, is the first basic requirement before we can project levels higher. On the way down, I think the reversal level for the Bank Nifty stands at 41,861. That's a quick setup. I think you're starting with more positive more sort of macro-ish positive cues, and of course, some of the local factors, which is earnings-related cues, are also pretty good. Guys, hi.
Absolutely. Hi, morning. And the interesting part is that the market has now moved to the higher end of the trading range, right?
Yeah.
So does it break it on the upside? These are the way the cues are stacked up. It looks like we could. Now, it's the second straight week that the markets have gained. And for me, the most important cues are the earnings. And all three earnings, as Prashant was also pointing out, Kotak, ICICI and Reliance hit it out of the park this time. In fact, across all parameters, whether it's net interest margins for ICICI Bank at an all-time high, gross NPAs, asset quality, very strong, gross NPAs at a multi-year low. Across the board, brokerages, a lot of them have raised their target prices as well. Reliance, it was the O2C business that drove an earnings beat. And these three constituents put together could make sure that the market has a very strong start. At least that's what the SGX Nifty is indicating. The global handover was also very strong. Third straight week of gains for the Nasdaq. Of course, there was selling pressure that came in from the FIs on Friday. So the big question is this, could the markets break the upper end of the trading range? The trading range so far has been 17,800 to 18,200, and now we are almost at the upper end of that range. So are these cues enough for the market to break above it? At least the morning will be quite solid. Now, through the course of the week, you have many important earnings, so we're going to continue talking about that. Today, there's Axis Bank, so will it, take the sort of legacy forward after very strong numbers from ICICI and Kotak? Time will tell. Through the course of the week, a lot of auto numbers coming out as well. Maruti, Bajaj Auto, Tata Motors, etc. So we'll keep our eye out on that. But looks like the bulls have reclaimed ground and are sort of tightening their grip a bit on the market.
Well, it's going to be a little tricky, Sonia, this morning because the SGX Nifty is suggesting such a big gap up, and we know that we're going to be opening up more in that congestion zone. So run you through a few cues. The institutional flows, well, they're not very encouraging. On Friday, in fact, it was the worst in comparison to the full week. So the FIs, they sold 2,000 crores. The institutions, net institutions, that's the DI and the FI put together, was 500 crores odd. That was, probably the worst flows that we saw in the entire of the week. For 4 days, it was pretty good. Then, in fact, they gave it away. What did the FIs do in the F&O market? Well, they added long positions. Now, in fact, they added close to around 10,000 long contracts, and the long positioning has moved to around 53%. I would prefer shorts in the system, but that's, in fact, what the FIs have done. On the call side, well, they're writing calls very, very aggressively. 2.5 lakh, call contracts were written, and there were 2 calls for 1 put. So maybe, in fact, these call writers, they still believe now that 18,250 is going to hold out. Let's run you through a couple of options then. The 18,100 call, very, very active. 18,200 call, very, very active. And there was a sense that you saw writing at both these 2 strikes, which brings us to the level. It perfectly ties in with what we are looking at. In the past week, the 18,150 to 18,200, we visited that range, 3 out of the 5 days. And from there, in fact, we did see some sellings. Just pull up the highs, of the last few days. Those are the highs that we saw in the past week. And we ended closer to around the 18,000 odd mark. So we're likely to open up in this congestion zone. Getting past this is going to be very, very important. On the downside, a couple of levels you're looking at. Yes, we're going to gap up, but on a closing basis, irrespective of what happens during the course of the day, you want to defend that 20 DMA, 18,045 watt. If you break that, then you slide further to around the 100 DMA. I'm not talking about the 50 DMA, that's around 18,300, 18,250 to around 18,300 odd. So the SGX Nifty is suggesting a gap up. The advice would be, don't chase this gap up of around 100 points odd, because we're starting in the congestion zone. If you want to buy, well, then you should be, looking at that 18,000, 18,040 odd. That's a crucial support zone. If that holds out, maybe you're good for more. But for starters, don't chase this gap up opening.
Okay, well, let's see how it plays out. For now, the start is expected to be very strong. We have lots of opinion coming through this morning, so let's get straight to that. Surendra Goyal of Citi says the near-term volatility in equities around the union budget has overall been on a declining trajectory in recent years post the GST implementation. He says recent negative reactions post the budget are owed to imposition of new cesses or surcharges or changes to capital gains tax regime. In that context, rationalization of the LTCG regime to raise tax rates, increase or ease eligibility duration might have a negative impact. More medium-term, earnings downgrades or a slowdown in domestic flows and continued shift to other emerging markets are key downside risks, while a global soft landing in 2023 can support. He says they recently upgraded consumer staples and metals to neutral in their sectoral preferences.
Well, let's get you some money market views as well. This is B. Prasanna of ICICI Bank, who says the dollar remained weak on the back of weak economic data. from the US, but the rupee has underperformed with appreciation limited by RBI interventions. For the week, Prasanna expects the rupee to trade with an appreciation bias and in the range of between 80.7 to 81.5 against the dollar.
Okay, and on the bonds, B. Prasanna says that the global yields continue to soften amid speculation that the Fed is likely to end the tightening cycle sooner than later. However, domestic bonds remain under pressure owing to upcoming fiscal budget and hawkish central bank rhetoric around inflation. Prasanna expects bonds to likely remain range-bound going into the event, that is the budget. He expects the 10-year benchmark yield to trade between 7.25 to 7.40%.
Okay, Rajat Bhattacharya, a senior investment strategist at Standard Chartered. He joins us now to take some questions. Rajat, good to have you with us here. Thank you very much. Let's just begin with what is new. What is new was that powerful rally we saw on both the Nasdaq and the S&P on Friday. I mean, actually, this year so far, Rajat, it's been very clear, right? Very different as compared to last year. Equities are higher. The Nasdaq is up 7% year to date. Yields are lower. The 5-year is down 50 basis points year to date. And the dollar is weaker as well. So this is a risk-on kind of a setup. Your sense overall, Rajat, in terms of how things are looking?
Yes, morning, Prashant. Yes, that's right. It is a risk-on setup, unlike what we saw last year. And that's primarily driven again by the central banks. Last year, the central banks turned hawkish end of 2021, and that we saw filter through in last year's January. This year, people are expecting then central banks to turn more dovish, as in they will slow down the pace of rate hikes. Now, that is what has driven the yields lower, the dollar lower, and stocks are slightly higher. But we should caution there. We're not so sure that the Fed, or for that matter the ECB, have done with the rate hikes yet. I mean, we see actually the Fed going another, let's say, 75 basis points higher in the next few months. So next month, on 1st February, they might hike by 25 basis points, but they'll keep going on till they see inflation month on month. That month on month inflation number in core inflation needs to come down. So they need to see month on month inflation go down to 0.1% or even flat or contracting before they stop. ECB, in fact, we have a upside risk to ECB rate hikes. Why we say that? Because in Europe, the winter has been not so harsh. In fact, it's one of the warmest winter in Europe on record. What that means is that the energy crisis that people were expecting, the tail risk, that has gone away. And as the tail risks go away, European indicators are reversing strongly. And again, set that against the core inflation, which is still rising, which is rising steadily, and it's above 6%. ECB is really worried now. So ECB rate hikes might go higher. So in the West, rates are probably going to go still higher for some more months. So we need to be cautious a bit on stocks in terms of the West. In fact, our latest call has been fade the rally in European equities. European equities have outperformed US equities. To your point, European equities have done much, much stronger, and it's time to fade the rally there.
Okay. Well, at that point is taken, but back home we're noticing some very interesting trends. We of course have the big union budget coming up. There is some talk of taxation, which of course may not go down too well with the street in terms of tweaking of the long-term capital gains tax definition, etc. But that all is just rumors at the moment. What we're also noticing is that the earnings picture is shaping up really well, especially with some of the larger private sector banks. Would you, in a market like India, increase your allocation to some of these spaces?
Hi, Sonia. Yeah, well, India, you talk about the budget, and it is time probably for some consolidation because India loses the budget to react to the COVID crisis. But in terms of the market itself, it's still richly priced because you see that when you compare with the rest of Asia. We've seen the rest of Asia outperform significantly India, and India's held its ground. So in that sense, maybe not time to add in India, but structurally it's a strong story. To your point about the economy itself, what we're seeing is the private sector, private demand for loans is picking up. That's a positive sign. India has always been a domestic demand-driven story. It's going to be more relevant. Domestic demand is going to be more relevant this year, given the slowdown we're going to see and a possible recession in the US and probably Europe this year. So India's organic growth that we see in the rising lending demand and the private sector, the confidence picking up is positive for its future earnings and growth. So I wouldn't sell India, but I would add here given the relative valuation that is there with the rest of Asia.
All right, Rajat, very quickly, if you could tell us expectations on crude oil. It's suddenly moving to around $88 per barrel. I recall you saying that you're expecting it to move down, and that was the big call, but unfortunately, it's moving up. Quick take?
Yeah. Crude oil, I mean, it's on the longer scheme of things, it's trading within that range. It has fallen off significantly from the highs of last year. And again, a lot of that has got to do with the fading of tail risk in Europe, and also the slowdown in the West. Now, one of the drivers of crude oil, upside drivers, is obviously China's recovery, and there are evidence. There's evidence that it's recovering fast because the COVID cases in the big cities have peaked in China. So if China recovers faster than expected, there is scope for support for crude oil, but we don't see it going, significantly higher, and that is good news for India. That's one more good news for India in terms of its balance of payments.
Okay, well, thanks for stopping by and speaking with us. Have a great 2023. Of course, we'll chat with you again very soon.
Welcome back. You're tuned into Bazaar Morning Call. Well, the HDFC is suggesting a gap up, but there are plenty of stocks that we're going to be tracking, and our research team is standing by to run you through CNBC-TV18's top 10 stocks for the day. So now you go first. Reliance Industries, big boy. How are the numbers?
Oh, good numbers. No complaints at all. In fact, the numbers were better than estimated, both on a consolidated EBITDA and a net profit front. It was a very strong growth for the oil to chemical business. So that was really the star of the show this time. The O2C EBITDA went up 16% quarter on quarter. And the oil to chemical margins, they were 7% last quarter. They improved to 10% this quarter. So that really was the piece that the street will like the most. It was a steady set of earnings from Reliance Jio. No complaints there. The average revenue per user has improved to 178.2 rupees. However, there was no talk of or no clarity on the tariff hikes at the analyst call. So that's just something that the street might ponder over. The retail business continues on a very steady footing as well, a revenue growth of 4%. The consolidated numbers will be up for you on your screen. EBITDA went up 13%, net profits went up 15%, and most brokerages have given it a thumbs up. So I just pulled out 3 of them for you. Nomura, Jefferies and JP Morgan. Nomura has a buy, target price 28.50. Jefferies and JP Morgan both have a target price above 3,000. Of course, standard disclaimer, Reliance Industries is the owner of the channel that you're watching, but the numbers were definitely above what the street was estimating.
Okay, all right. So that's about big buy Reliance Industries. Well, let's hop across to Abhishek. He's here to tell us about ICICI Bank's numbers. Hi, Abhishek. Morning.
Morning, Nigel. So records continue at ICICI Bank. The net interest margin is perhaps at an all-time high of 4.65%, with international net interest margin also being one of the best in last 3-4 years. So NII growth is the best in 7-8 years or even more for the bank, coming in at more than 34% YOY. Operating profit growth, that's being led by the NII growth. So it is also at 15-quarter high. Asset quality, both the gross NPA and the net NPA ratios are one of the lowest in 8 years or even more. However, on the flip side, the deposit momentum, that has slowed down a bit, and it's one of the lowest in last 27 quarters, with CASA ratio being the lowest in last 2 years or 8 quarters. In terms of PNL, both the NII and PAT is a beat on our poll. Back to you.
Okay, that's on ICICI Bank. So that definitely will be one of the stars of the show. But Ultratech, you're watching that as well?
Well, that's right. So the numbers, they were a little bit mixed, but I'm going with green out there because it's the big boy, and valuation-wise, well, it's got some bit of support. So run you through the numbers. Well, the revenue, the EBITDA and the profitability were bang in line with what we were working with. However, on the volumes front, it's a little bit better. So grey cement volumes, which is the core part of their business, that was up close to around 13%. That came on a low base and shows you that demand as well is resilient, and the management comments as well say that demand is fairly good, so no worries out there. The only worry was realizations. It was expected to go up by 2 to around 3% odd. It came in at less than 0.5% high on a sequential basis. Now, this is not very bad news for Ultratech Cement, but for the read-through for the industry, that will be a little bit worrying. So we'll have to keep an eye out to see how the other stocks react as well. And debt reduction continues, close to around 600 crores odd. Remember, they're incurring capex. but yet the debt reduction continues. So I'm going with green out there. We'll get further details post the con call that's scheduled later for today.
All right, Nigel, thanks very much for that. That's Ultratech for you. But now Kotak Bank is the other banking major which reported numbers of the weekend. Abhishek is back with us to take us through the details. Abhishek.
Well, Prashant, records galore over here as well for Kotak Mahindra Bank. The net interest margin is the highest in many years that I've seen, coming in close to 5.5%. So the NII growth rate, one of the best that you are seeing on a YOY basis in 26 quarters, and sequential growth is one of the best in last 29 quarters at more than 11%. So deposit growth, it's heartening to see that while other large lenders are not seeing deposit momentum on a sequential basis, Kotak Bank has seen a strong deposit momentum on a quarter-on-quarter basis, one of the best in last 11 quarters. The loan growth continues to remain strong, close to 23% YOY and about 5.7% sequentially. Asset quality, one of the best gross NPA and net NPA ratios that you are seeing in last 7-8 years. Robust ROA, close to 2.5%. What doesn't work is that the treasury loss continue for second quarter in a row. It has declined on a quarter-on-quarter basis, but it's a loss. In terms of P&L versus RPOL, it's a strong beat both on NII and PAT. Back to you.
Thanks a lot for that. So that's on Kotak Mahindra Bank. But how about JSW Steel, Nigel? How did it look this time around?
Well, JSW Steel's numbers actually, Sonia, were a little bit better than what we were working with. So on the top line, it was a wee bit better. The margins were a little bit better as well. And let's highlight a few factors out there. The standalone EBITDA per ton, that's a domestic business. It came in at around 8,141 rupees odd. We were working with a number of close to around 7,900. So close to around 200 rupees beat out there. And it's improved on a sequential basis as well. So good news out there. Bhushan Power and Steel, well, that was a big swing factor. From an EBITDA loss, it moved into a EBITDA positive terrain. So good news out there. Though the debt number has gone up, that's predominantly because of higher inventory and the forex element as well. The management says that the inventory will gradually get pulled down in the quarter 4. And also, we know the rupee has stabilized. So unlikely that the debt moves up from these levels. Going with green on that one. Though valuation-wise, it's the most expensive steel stock, which could be a bit of a spoke out there. But moving across to IT yet again. Rima is with us to run us through LTI Mindtree numbers. Rima, disappointing, right?
Yes, so this is the first the results that the company has reported post its merger, and it's a miss on revenues and margins. So it's a top-down miss. Revenue growth at 1.9% is lower than anticipated. Very sharp margin contractions. EBIT margins at 13.9% is down 360 basis points quarter on quarter and down 460 basis points on a year-on-year basis. The company said part of it is on account of furloughs, fewer working days, but also due to one-time integration costs. The company said the miss on the top line to the muted performance on top line was on account of furloughs and lower working days. They've also given us a forward-looking guidance. In the next 4 to 5 years, they expect revenue synergies of $1 billion and a margin improvement of 200 to 300 basis points over and above their pre-merger level of 17.5%. But this is over the next 4 to 5 years. But for the quarter, it's a big miss, and I'm going to go with red. Back to you.
Okay, going with red for LTI Mindtree. Interesting there. It's been such a mixed bag across the mid-cap IT space. But Abhishek is here to give us some more numbers that he's tracking. Abhishek, over to you.
Well, Sonia, to begin with IDFC First Bank, the slippages have remained elevated just like in the previous quarter at around 1150 crores. Asset quality has seen improvement both in the overall loan mix as well as the retail portfolio. The net interest margin has inched up by about 28 basis point quarter on quarter, which has led to ROA being above 1%. Operating efficiency remains weak with cost to income ratio at 71.6%. P&L, it's a slight, NII beat. However, PAT is well ahead of our poll. Yes Bank missed back given the fact that asset quality has improved because they sold NPS to ARC or Asset Reconstruction Company. But slippages, they remain elevated, which is a worrisome factor. The loan growth, that's a tad miss. They are losing market share both YOY and quarter on quarter, which has led to net interest margin declining on a sequential basis. The PAT is at 7-quarter low and return ratios are one of the worst that you can get for private banks. In terms of their reporting, the PNL is below ICICI Securities estimate. Bandhan Bank, the MFI book is actually declining both YOY and quarter on quarter, and stress continues to come from there. The net interest margin is at 20-quarter or all-time low at about 6.5%. Other income is the one which has actually helped in the profitability this time around. Asset quality slippages remain elevated and gross NPA NPA ratio and net NPA ratio, they remain stable. In terms of P&L, both the NI and PAT is below our poll. SBI Life annualized premium equivalent, that's the only one to beat our poll. However, value of new business as well as value of new business margins, they are well below our poll. Value of new business margin is actually 200 basis point below our poll. Profits, they have come in at 300 crore. We are working with a number of 424 crore. So a red over there. Back to you.
Okay, thanks a lot for that. So plenty to digest in terms of numbers, but let's just give you a quick run through. Stocks with positive news flow. There's Reliance, ICICI Bank, Ultratech, Kotak Mahindra Bank, JSW Steel, IDFC First Bank and Yes Bank. While LTI, Mindtree, Bandhan Bank and SBI Life are stocks on our radar that are likely to open in the red. We'll take a quick break. On the other side of the break, we'll have with us Vibha Padalkar, who's the MD and CEO at HDFC Life, to discuss their Q3 earnings. We'll also be joined by Prabal Sen, the energy analyst at ICICI Securities, and Balaji Subramaniam, the Vice President at IIFL Securities, to discuss the Q3 results of Reliance Industries. Stay tuned. Well, we're bracing ourselves for a good opening this morning, but let's get to some stock talk now. HDFC Life is the first corporate we're speaking to after their Q3 earnings. The company posted a strong APE and value of new business growth, but the margins struggled a bit, came in lower, likely due to the lower margin business of Exide Life. But let's find out more. We have Vibha Padalkar, who's the MD and CEO of the company, joining us now. Vibha, good morning and thanks for being with us on the show. Can you tell us how do you see the Q4 performance shape up and what exactly aided the APE growth in Q3?
On the total APE, a few things that have worked well. On the retail APE, we have grown faster than the sector. And this is firing on all cylinders, especially our agency channel. Share of our agency channel has gone up from about 14% of our business to 18% of our business. Annuity again has done exceptionally well. We are ranked number one in terms of in the private sector and also have grown about 60%. This is both individual plus group. Also, if you were to look at growth in renewal premium, that has grown very robust on the back of excellent persistency. So it's a combination of all of this. Credit Life has grown about 52%. So all of that has come together and it has been a broad-based growth, very much in line with our strategy of having a balanced distribution mix and balanced product mix. So that culmination has happened. And lastly, as you know, we've done the merger with our subsidiary Exide Life. And that too has dovetailed into this, giving further accretion to our top line.
So could you give us some numbers? What do you see the APE growth, say, in Q4 of this year?
At least on the retail APE side, we should grow faster than the sector. And that would mean about 15 to 18% growth on the retail side. On Credit Life, we should continue to be the market leader. We are number one in the group private space. And we continue to hold that position. That's how we see that. Growth so far has been 50-60%. Again, we should track somewhere along those lines.
Vibha, good morning. Despite strong overall growth, margins have come in lower. Is this the result of merging Exide Life into the company? Or is it just the underlying business?
So I want to clarify here, the margins actually have been very robust. The poll, etc., that you talked about, that's on a standalone HDFC Life basis. The margins that we have put out now, and like I mentioned in my commentary on the investor call, is that we will be only disclosing company level, consolidated company level margins. And as we mentioned, say in Q2, at the time of the merger approval coming through, that Exide Life's margins were high single digits. And we said that for us to get to margin neutrality, meaning the same margins that we had same time last year would take at least a year, if not longer. We have actually been able to extract synergy. So we have advanced the margin neutrality date. And so we are actually very pleased about it. To give you a sense, last year, 9 months, last year was 26.5%. This year with Exide Life, like they had single digit margins that we mentioned last quarter, despite that, we have got 26.5% margin, which means standalone HDFC Life margins are significantly higher and very comfortable with some of the numbers that you talked about. It's just that it's not visible because these are combined numbers. Same thing on the third quarter. If you see standalone third quarter, again, there's margin accretion wherein standalone was 26.8% Q3 of this year and 26.8% Q3 of corresponding period last year. So again, there's been a steady quarter-on-quarter uplift of margin. This is, of course, at a consolidated level. Again, the clarification is HDFC Life standalone, hypothetically, would have been much higher levels of margin.
Just to clarify, Vibha, so margins for quarter 4 and for the full year should look better, right?
So we should end the year again very close to margin neutrality, because this is just synergy extractions are still happening. So that's the kind of level that we are likely to close at.
Okay, so once the Parliament approves these insurance amendments, how much time do you think it would take for you to enter the health insurance market? Because that's the big question on everyone's mind.
It should take about 6 months or so for us to really ideate, because right now it's not that we do all the time, but final form or shape, the devil is in details as to what can one do, what can one charge, those sorts, which channels can sell, can I do direct, many such things. So we'll have to see those contours.
All right, Vibha, does it make sense to merge HDFC Ergo into the current listed companies rather than having two companies from the same group operating in the same health insurance market? What are your thoughts?
So the way I look at this is slightly different. More than the here and now obvious about, do you merge or not? That is that's a tactical outcome. The way I see it today is that, can I, for example, do things that a general insurer, because of perhaps amount of capital and so on, cannot do? For example, today, every year, if a health policy is repriced, or every few years, what if I were to charge more, but I'm giving a guarantee like I give for life insurance, wherein if a person takes a protection policy and unfortunately in a week's time is detected for a major illness, I as an insurer cannot reprice it no matter what. Like that, if I were to charge a little bit more, but I give a guarantee that until a person is alive, this is covered, or maybe for the next 10 years or 15 years. These are sort of innovations that I would be focused on, rather than saying that, it's a zero-sum game. Either HDFC Life gets it or someone else gets it. That's not how I'm looking at it. I'm really, because really the pie can be expanded to many different avatars, like this couple of examples that I've given you. So that's how I would see it. Disability is another one today, because it's easy to say no to it, because it does require capital, because of much higher levels of potentially a claim. So and the pricing has to be right, but at a price one can cover risk. So it's a question of what price, what is the underwriting, how much does one retain on our books, how much is reinsured, and and so on. So it's those sorts of things that would enthuse us.
All right, great conversation, Vibha. Good luck. Thank you so much for joining us. It's a fascinating business to understand and kind of discuss. And there is so much happening in this space, right? So many new regulations which will come into full force this year and the year ahead. And it'll be interesting to see which one kind of comes out the winner. Stocks have underperformed for a few years now. So it's in a way an interesting space. I put out ICICI Pru as one of the stocks, slightly longer term, with a longer term view on market laser towards the end of December. That was at about 450 or so. Stocks moved up a little bit, but this is a space as such where I think there is a fair bit of interest after a few years, which may start to come back. Prakash Diwan is with us, market expert, to talk about market fundamentals and how he sees things, and a lot to discuss. Prakash, morning. ICICI and Kotak, right? I mean, actually more ICICI than Kotak, because Kotak is underperformed. ICICI is not underperformed, but it's not done as well relative to all the beats we've seen for so many quarters now. Numbers, no problems. But there has been FII selling, right? And that is, even though upgrades have come in thick and fast after every earnings said, stocks have really not gone anywhere for the last few quarters. What's your sense? You think, this time will be, numbers are solid, no problem, but what happens to the stocks from here, both ICICI and Kotak?
Good morning, Prashant. That's right. I think there are two factors that you need to put in context to explain why ICICI and Kotak have both lagged. in terms of performance relative to even some of the private sector names like Axis, for instance. Yeah. The first is that the market's love for PSU banks certainly has been center stage. All the allocations into the BFSI side which have come in the last 2 quarters actually have been thanks to the revival in performance from these PSU banks, including of course the smaller ones, not just restricting itself to the SBIs, Canara banks, BOBs of the world. The second factor is that the FI exits have been much more weighted. So wherever you had weightages, and after the HDFC Bank went into that pause of sorts, HDFC Bank has been in a pause mode for almost a year now, and till the merger is kind of out of the way and there's clarity, and now it seems like getting closer to that stage. There was nothing much in terms of option but to get out of these 2 banks if you had to exit ETFs particularly. So that was the other reason. But if you look at the numbers which came through over the weekend, very clearly Kotak has made a comeback of sorts. I mean, after so many quarters, they've seen a little bit of expansion in their names. They're coming back to what always used to attract premium valuations. 4 times book was a very common thing for Kotak along with HDFC, whereas ICICI would still kind of be good enough in that 2.8, 2.93 times price to book. So that was the reason why Kotak was getting punished, because it didn't have numbers very consistently. But finally, I think they seem to be getting it right. But they're extremely cagey about still expanding the book, from what I hear from the market, and that's one of the reasons why you may not see very clear growth that's very decisive of sorts. And that was the reason why the market didn't somehow like that. Whereas ICICI has, of course, been galloping ahead with so many other things. Some of parts also kind of favors it, given the businesses that it has. Some of them still remain unlisted. So I think precisely what's going to happen is you will see a comeback for both these banks at some point in time when the entire private sector bank basket gets re-rated. But you'll still have to, they would have to wait before the Axis and the HDFCs also start coming back. So it's going to be a positive rub-off on the other banks. But I don't think this is just going to be good enough for them to play catch-up on all that lost ground.
Okay, we also have to talk, of course, about Reliance Industries, right, Prakash? That was the other big number that came through.
Yeah.
I do know your view on that, so I'm just going to, make you wait a tad bit because we have 2 more guests joining in. Probal Sen, energy analyst at ICICI Securities, and Balaji Subramaniam, the vice president at IIFL Securities, join us now to tell us how to approach the numbers and the stock, of course. Prabal, let me start with you because the star of the show was undoubtedly the O2C business. And over there as well, we've seen, a good double-digit growth sequentially in the operational performance. What about the stock? What is your expectation today and overall on the numbers?
Well, I think the numbers were obviously encouraging. What we have really seen is that despite Singapore margins or theoretical Singapore margins actually declining by about $2, our sense is that GRMs for Reliance and indeed some of the other players should have actually gone up, primarily because the key product spreads of diesel, ATF and gasoline, which make up more than 60% of their product slates, the refining product slates, have actually remained fairly strong. The benchmark margins have a lot more weightage to other products like LPG, NFO, and so on, which have not really done so well. So that dichotomy between, or the gap between Singapore benchmarks and Indian players' GRMs will continue to grow. I think even for the coming quarter, if the extent of Russian crude that we keep hearing in reports is actually flowing through, that should also provide an additional driver because crude costs will probably be lower. So from an earnings momentum perspective, we definitely believe that Reliance should actually continue to improve numbers for the next few quarters. Jio has shown fairly steady results. Retail continues to actually, I think, outperform estimates. The one surprise for us was the fact the price realizations in the upstream segment were also very, very strong. And with the expectation that another 10 MMSCMD of gas production should come through by the end of this financial year. So to that extent, I think, even that segment should actually start pulling its weight even more. It's interesting to look at the earnings mix for the company. The consumer businesses today now are contributing more than 50% for the last couple of quarters in their consolidated EBITDA. And OTC, despite the kind of improvement seen, is less than 40%. So that the driver continues to change, the business mix continues to change. And I think earnings growth should continue to accelerate for the company over the next couple of years.
Okay, earnings growth should accelerate for the company. Balaji Subramaniam, Vice President at IIFL Securities, is also with us. Actually, the analyst call had a lot of positive commentary coming through on how the business is expected to improve across the board, whether it's O2C gaining from strong GRMs and rising petchem spreads, or even in telecom, the focus is to fast-track the 5G rollout. But Balaji, the only niggling worry, one, is that there was no specific timeline on the tariff hike, and that is one of the reasons why the stock has also, seen a lid on its gains. And the other thing is the debt of the company has gone up about 18% sequentially compared to last quarter now. Would that be a concern for you? And on the stock itself, what's your view?
Hi, good morning. So on the we see a steady performance. We had about 19% YOY revenue growth, but that was largely led by the tariff hikes that were taken in late 2021. I think the biggest trigger for the stock is what is going to happen on tariff hikes. My sense is that considering the significant investments that the company is making into 5G, the chairman had mentioned as part of the AGM speech that the company would be investing about 2 lakh crores in the next few years on 5G. And my sense is that most of it would be front-ended, as we are seeing that 5G rollout has been happening at a pretty rapid pace. So I would still believe that some tariff hike is probably going to happen sometime during the calendar year 2023. And, I think till that happens, the stock might probably be range bound, especially with respect to expectation on the geo front, because as you said, the investments are happening, the debt has been rising, and RIL as a company has done more than 1 lakh crores of capex in the past 9 months. So I think the clear route in terms of monetizing those investments, will be contingent upon timely tariff hikes being taken, and I think that will be the single biggest trigger for the stock.
Okay, in fact, I wanted Prakash Diwan to come in on this as well. Prakash, the capex has gone up for them almost 16% compared to last quarter. Considering that there is this massive 5G rollout happening. There's also an aggressive expansion plan in the retail business. They are adding 6 million square feet over almost 800 new stores. Do you think the delay in the tariff hike and the rising interest because of the capex, do you think it could keep a lid on the gains? Because there are a lot of brokerages that have actually taken down their FY25 EPS because of the, the pressure that we're seeing on the balance sheet.
So, Sonia, yeah, it is logical that you will probably have earnings being back-ended and the capex being much more front-ended. But then we've seen what happened when they actually rolled out Jio, right? They had a massive debt of almost 185,000 crores, which they repaid, became net debt-free. And the last 2 years, most of the capital is gone to to intensify and deepen the footprint on the retail side, the kind of acquisitions they made, the kind of expansion in terms of geographical footprints. Now, all of that is probably coming to a mature stage. So retail doesn't probably become capital hungry. But if you don't roll out 5G quickly and let the competition roll out, I mean, your market share that you kind of can assume with this kind of a strategy is far more superior, qualitatively and quantitatively both. And for that, you will have to roll out, incur the capital expenditure in the front-ended side. But the price hike can only come once you've got a critical mass of 5G rollouts in cities. I mean, I think it's commendable that they've already reached this number of 174 cities, and it's going to keep on expanding very rapidly, as Balaji also mentioned. So this is far more faster than what we anticipated, and the price hike will happen once that critical mass or the tipping point is done. So you'll probably see, the money coming back after the price hike from 172 ARPU if you go towards 200 quickly. Though if it's in the middle of, let's say, calendar 23, it kind of sets off the huge debt that, or the significant debt that could probably build up in that, period. So I'm not too worried, but yes, the mathematical EPS growth will probably be some time away, and hence there could be an argument for a slightly lower estimate and hence a PE multiple that's probably not very, very gratifying. But I think it's a great opportunity. The fast-growing hydrogen business also will start seeing some numbers after a year and a half. So there's much more vectors working towards it. And that's exactly why you buy into a stock, because it offers value in the long term.
All right. Well, that's on Reliance Industries. Prabal and Balaji, thanks a lot for joining in and giving us your quick take. And Prakash, I would request you to stay on. So that's the sum and substance. Yes, the numbers are good, but there are some worries over the earnings. One, the debt has risen quite a bit. There's no clarity on tariff hikes. And capex has surged significantly, leading to a couple of EPS downgrades as well. Before we slip into a break, let me tell you what's lined up in the next half hour of the show today. At around 8:45, Anuj will join in for a quick trade setup. Post that, we will bring you the top stock picks for the day from our technical experts. Following this, Prashant will bring you the Market Laser segment where we analyze stocks and sectors through a technical lens. And before the market opens in CNBC TV18 Stocks Board, we highlight the top stocks in the news to focus on for the day.
Okay, welcome back. We are sort of going towards market pre-open. 6 minutes to go for that. Let's bring in Anuj, who's with us here in our studios for a quick setup on things. Anuj, hi. Morning.
Hi, morning, Prashant. Well, there's a bit of a gap up, and I know Nigel and Sonia are having a bit of an adrenaline rush because of the game last evening.
Yes.
But,
We're feeling good, Anuj.
Just control yourself.
Top of the league, right?
It's been a long while, Anuj. We felt like
before you could troll me, I thought, let me just take it on, head on. So, anyway, look, this is a truncated week, but a big week nonetheless. Last week before budget, monthly expiry, and results are strong. US market surge led by Google, but that's my worry that, there's too many good things for the market and there's a gap up. And buying after gap up has never been a good strategy in this consolidating or oscillating kind of market. We need to see how Reliance and ICICI Bank move actually after any kind of gap up. Just look at the Nifty highs and lows, and Mangalam helped me with this data, so thanks to him. The highs have been lower for the market, and the lows, barring one day, have also been lower. So let's see. Today there's a risk that we have an outside day, which is that we start above 18,145, yesterday's high, and if the market starts to fall, then maybe even break the low, which is 18,016. I mean, that I think could be an interesting thing. The Nifty is 20 and 50 day exponential moving average are placed at 18,100. So again, not a zone in which you want to perhaps initiate fresh longs because there's big resistance between 18,125 to 18,150. Support zone for the Nifty is 17,975 to 18,025. On the Bank Nifty also, there's a risk of some profit taking because it went into the earnings strong on Friday. And while the numbers are strong for ICICI Bank and Kotak, numbers were never the reason that these stocks fell. They have their own concerns. ICICI Bank, maybe some FI selling. And in Kotak, this MSCI factor did not open up because of the shareholding pattern. So my sense is at higher level, these stocks would be vulnerable to profit taking. HDFC Bank, on the other hand, still remains the strongest stock in the banking pack, and the resistance for the Bank Nifty is 42,650 to 42,750, according to me.
Okay, thanks a lot, Anuj. Have a great day. Well, for now, we just have a couple of minutes before the pre-opening rates kick in. We will also have Krishnan ASP of HDFC Security to discuss the Q3 numbers of ICICI Bank and Kotak Mahindra Bank. Stay with us.